Next, we'll pick up with the trial balance, and the trial balance is just a listing of all of the ending balances in our ledger. So back in our ledger, for example, cash is $12,200 as a debit, and so is accounts receivable. It has a debit of $5,800. So in our trial balance, we'll see that listed as a debit in both of those cases. All of the debits will be listed, all the credits will be listed, and the totals should equal each other as long as we don't have any errors in postings. Next, after you've prepared a trial balance, at the end of a period, and these are dated as a 9/30, we'll have a number of items that need to be adjusted to get a truer picture of revenues and expenses. And usually the case will be in our normal entries that we'll have to record revenue that hasn't been recorded and record expenses that haven't been recorded. So here we've got 9 different items that need to be reflected in our financial statements, and those will all produce journal entries that will be posted in your journal. So for example, the first one, depreciation using the straight line method, full month. If you remember, we purchased equipment, and this is telling us it has a 5-year useful life with a salvage value. So if we go back to our transactions briefly, we'll see on 9/3 we purchased a truck for $8,000. So we're going to take the $8,000, subtract the salvage of $2,000, and we'll divide by its useful life of 5 years. And that would be $1,200 for the year. We would divide that by 12 to get 1 month's worth, and that's where we get the $100 of depreciation for 1 month. We also are going to look at interest, and it says compute the interest expense on the note. If we go back to the transactions, we had a note payable on September 5th for $7,200, and it was a 10% note. The interest rate that's listed is going to be an annual rate of interest, and so we'll need to adjust it because we're only going to need 1 month's worth of interest. So in this case, we have your note times 10%. We would take that and divide that by 12 to get 1 month's worth. On the third one, we had $50 in dry cleaning that was redeemed on the customer's account. No computations that we need to perform for that, but we'll need to record an entry to recognize the revenue. Here we're going to have to recognize new expense. Accrued salaries of 9/30 have not been reflected in our books, so we're going to have to increase expense. Here we've got ending inventory supplies of $280. If we go back to our transactions, we would look to see what did we start with in our cleaning supplies, and it was at $1,200 on 9/6. So we're going to have $1,200, and we're going to subtract the $280. That's where we'll get the $920, and so that's what we've used up, so we would have to expense $920. Number 6, 1 month of insurance had expired. Again, I need to go back to my original transactions to see what insurance I purchased. And I purchased $1,800 policy for 1 year. So I'm going to take the $1,800, divide that by 12, and I'll expense 1 month's worth. Here we earn but unbilled revenue was $600. We're going to increase revenue. Here we have utilities expense that needs to be recognized. And lastly, rent due for the month is $1,000. So let me just indicate whether or not I have to increase revenue or expense. First one, we're going to have to add more expense. Same with the second one, more interest expense. The third one, we're going to actually recognize revenue. Here we've got more expense. Here we're going to have a supplies expense, insurance expense. Here is something that we've earned as revenue. That's a revenue item. Utilities expense. And lastly, rent due for the month. That's going to be expense as well. All of those are journaled here. Then they're added to our ledger. So we would have all of these transactions were already recorded. And all we're doing is adding these last ones. So wherever you see the 930, those are the additional transactions, those adjusting entries that we were adding to get to a new balance. Our adjusted trial balance then has all of our updated balances. So this is going to look different than our unadjusted, and it's going to reflect all of our adjusting entries. From this, your adjusted trial balance, you're going to take each and every one of these accounts and you're going to pull them into your financial statements. First, you have your income statement. Your revenues minus your expenses are listed here. Your income amount of $1915 is going to flow directly into your retained earnings statement. And you're going to get an ending retained earnings balance of $1015. Lastly, you'll have your balance sheet, which will have your assets, your liabilities, and your equity. And I want you to note that the ending retained earning balance of $1015 is derived from that retained earnings statement. Next, we're going to do the closing entries. Closing entries is where we're going to close out temporary accounts, and temporary accounts are going to be our revenue account, all of our expense accounts, our income summary account, and our dividends. So these are all of your temporary accounts. The rest are your permanent accounts that you would not close out. All of these temporary accounts are closed out to retained earnings. This is a simple process where we basically take what's in revenues, which was 80/50, and debit out that balance to make it zero and put it into income summary, which is a clearing account, a temporary clearing account. You'll see all of your expense accounts are credited to take those balances down to zero, and that's cleared through the income summary account. The net of these two is 1915. It gets debited out of income summary, which is that temporary account, and credited finally to retained earnings. Dividends is just a one-step process. You take it out of dividends, a temporary account, and put it into retained earnings. So basically what we're doing is clearing out all of our revenues and expenses. Those will go down to zero. Our ledger will have to be updated for all of these closing entries that we just walked through. And just notice that all of your expense accounts will be down to zero. Lastly, you have your closing trial balance, which reflects all of your adjusted numbers, and all of your permanent accounts are included here. So this is only your permanent accounts. Revenues and expenses are gone, and our retained earnings, 1015, is our ending retained earnings, and you should remember that balance from our financial statements. And that completes the accounting cycle from the journals all the way through to the closing trial balance. For homework, you're going to walk through and produce one example all the way through for a particular month in the same way.